Good morning, ladies and gentlemen. Well, this week the risk dial ended at -20, which is not too bad, to tell you the truth, given what's been going on. More importantly, the daily model and the weekly model have both gone into risk off, not by very much. As you can see, we basically deviated from -26 all the way to -20 this week, and we ended up with the moving averages giving a quick sell signal both in the daily and in the weekly, as you can see here, -3. Now, do I consider this to be extremely important? Yes and no. I think the model is based on moving averages, which are not precise things. They just give the overall direction. What it's saying really is that volatility is likely to remain elevated for the foreseeable future, and risk off is its preferred stance. Does that mean anything for day-to-day moves in equities or bonds? No, not really. As we will see throughout the video, I think this is unlikely to be a slaughter of equities. In fact, I am more bullish than bearish at these levels, but that does not change the way we approach things. We have to have a balanced approach and diversify at all times. The indicator that is much more reliable and should be followed much more closely for intraday and intra-weekly gyrations of the market is, of course, deviations, and it's precisely there to give you very good support levels. You can see how it caught. These are closing prices, yes, so you can see how anything below the green line was caught beautifully in SPY, and also in the sectors. We have finally got this to look properly, and you can see how XLE is very oversold. I expect a bounce here towards the 61 level, and also in IYZ, I bought some of that on Wednesday, I think. I expect a bounce to at least here, this kind of level. XLU is overbought, but what can you expect with bonds doing what they are? And XLB is also oversold, also a bouncer. XLK is the one that really fascinates me, and what it is saying is that it's unlikely to have closes below this reaction low. To me, that says, since it's the largest sector, says that the market is going to continue to be supported and basically trade in an area between the green line and the dotted line. So basically, I will show you later where that is in NQ, but that to me is a sign of a market which this week is going to be supported on the downside and have sharp reactions to the upside. XLF is also the one that I love. This was a wonderful buy area. Now XLF is again likely to trade to these levels, i.e. we are likely to go up towards the 27 odd area, 27.20, 27.30, and we will actually have a look at XLF later, because I think it's going to be a bellwether for what the SPX is going to do for a variety of reasons. And the other one that I bought on last week was here it is, it's the last one, was here, IWM. I think IWM is likely now to bounce from these deeply oversold levels up to the 152, 153 area. and that should be enough. So basically everything here is coming together and saying it's going to be a strongish week, with people who basically sold the market at silly levels around 28, 25, having to pay up and probably having to buy the market all the way up to 29.40, 29.50. A long-term map guide for what the market is going to do. The Blue Angels didn't let us down. Every time we got to 2800 or lower, the times 16 Blue Angel, 2800, 2820, that is the support level for bounces up towards the times 17. Now, at some stage, and probably as a lead of XLF, we might go down and retest those levels, but for the time being these levels are buy levels, and I will show you next why. This is why. Every time the dividend yield of the S&P 500 crosses above 47 basis points of the 10-year yield, i.e. it yields more, you get these yellow areas where basically people come in and buy the future yield of equities against the 10-year note. It is a natural rebalancer and basically supports the market. 10 years, we will see in a second when we analyze bonds, has come down so much that basically it is giving buy signals for equities on a yield basis. So it pays to be diversified here, because equities are now in a very decent risk-reward spot compared to bonds and bond yields. Whatever the risk on off model might be saying, which is based on lagging moving averages, I really doubt that over the course of the next couple of weeks, and certainly until Fed time, we see prices much lower than the low that we have seen in the past couple of weeks in SPX, which is around the 2800 area. In the 2-year note, my opinions really haven't changed. I think any reaction towards 166, 167 is going to be well bought, and the ultimate target to me is this 130 level, which was the first reaction high when we came off the lows. I really don't see much alternative. It might take a while, it might back up towards 162, but 130 to me is the level where this market is heading sometime ahead of the Fed meeting, which is on the 18th and 19th of September. I think personally that the Fed is going to do a 50 basis point cut, and the first clue that we're going to get to that is going to be the meeting in Jackson Hole, which is next weekend. I expect some strong hints that the Fed is likely to ease, and ease aggressively. The market will be very disappointed without it, and really you will have a strong reaction in both bonds and equities, because I showed you a while ago how the market responds to the yield differential and the yield differential in equities, in favor of equities. If that disappears, the market will have quite a bit of room to go to the downside, probably all the way down to the times 15 Blue Angel, which is in the low 2700s. So I don't expect the Fed to be as stupid as that. You never know, but you really cannot put your chips in on the Fed being stupid every time. So really you have to be looking for this 130 level to trade in the 2 years. The one market in the bonds that I think probably has still the largest potential from here is the belly, the 5 years. I think this 116, 117 level is going to be seen. It is going to take quite a few weeks, maybe 3 weeks to get there, because this is a weekly chart, but you can see this area here, how volatile the 5-year is. Basically trades between this 187 and 116 area. Any kind of move towards above 160, 161, I am going to be a big buyer of calls again in the market for a move down to 118. If you want to see what that looks like in the futures, well, here it is. So basically every time this market moves down towards the 118 level, I'm a buyer all the way up to go to 121.16. I think this is almost a given that at some stage over the course of the next few weeks we will trade 121.16, and I think the 5-year has the greatest potential of all in the bonds. And onto a weekly of the 10 years, you can see how oversold in terms of yield this is. We are within striking distance of basically the all-time lows around 139. It is unlikely to keep on going at this speed. Some backing up is more likely than not, and that is a very supportive thing for XLF. So basically between 185, I really like this 170 level as well, but between 185 and 140 is going to be the trading range that I can see for the foreseeable future, certainly until the Fed meeting in mid-September. So you have your trading ranges. Very unlikely that things are going to change that much that we go through 185. You can use the 169 as a swing level. Through 169 we see 185. That is an excellent level to start buying calls in the futures for a move down to 139. I really see no reason why 139 should be broken, certainly not ahead of the Fed meeting. Well, my favorite spread chart and my favorite thing to trade and position, the differential between the 10-year and the bonds, is doing what it should. Basically it's going from minus 245 where it broke this, you could call it an inverse head and shoulders, retest of the neckline here, a move of equality from basically 285 to 245 would take it to 210, and 210 happens to be an area where it traded for a very, very long time back in 2018 and earlier. So that is what I'm aiming for. That should coincide with slightly higher bond yields and maybe slightly lower 10-year yields, but certainly not below those levels that I gave you earlier. That 139 level I think is going to be very, very tough to break on a consistent basis. So really this is all I'm looking for. From 225 to 210, 15 basis points. Basically what I'm saying is that we've done almost over half of what we are likely to see in yield differentials, and it's made not a bit of difference to the DXY and to the Euro USD. This is to me saying a few more weeks of stability in DXY, and once we've reached this level and start backing off, we could start really seeing the DXY appreciate. And here's our trusted DXY. 200-day moving average keeps on catching it perfectly, and it keeps on staying in the upper part of the Bollinger Bands. To me this indicates a sideways market with, you know, very good levels that catch it around 97.52. Our year swing is here at 96.47, 96.50. I don't expect the market to come back there at all. I think 2 or 3 weeks trading between 97.52 and 98.50, 60 is more likely than not, while the risk-off currencies, the Swiss and the yen, do its own thing. They basically exhaust themselves, and then I think the dollar will be in a position to rally significantly and go towards those levels that are my ultimate targets on the weeklies, which are around the 101, 103 areas. If we change it to this weekly, you can see it. It's now, I think, gonna start crawling up the weekly Bollinger Band, and this 102 level and ultimately the 103 level is where I think they're more likely than not to go before we get a reversal in the dollar. In terms of weekly Euro USD, basically it's crawling down the bottom of the Bollinger Bands. In a couple of weeks' time, we will have opened them up even more. I'm pretty certain that 107.30 is a given at some stage over the course of the next couple of months. If we now look at it on a daily basis, you can see that these repeated closes below 111.08 are, to me, going to be very, very powerful indicators that at some stage this just collapses. And volatility really needs to start picking up for a variety of reasons. I think the cross correlation between the asset classes, the bonds, the equities and the FX goes in waves. We've had it in bonds, then it was followed by equities. I think the third shoe to drop is going to be FX at some stage. Well, our trusted gold against the S&P's chart, which has kept us on the right side of the market ever since this area here, i.e. long of gold relative to equities, and has given us the, basically $200 move in gold that we caught, is actually telling us that, there is a lot of room for equities to go up relative to gold, or for gold to come down while equities do nothing, one of the two, simply because we're so far away from these moving averages. So there is plenty of backup potential, which actually in the long term is meaningless, because we will still be in a trend where you're supposed to be longer of gold than of equities, i.e. favor gold to equities. Only repeated closes above this 2087 level and then above these moving averages, which is far more important, is going to give us a reverse signal. For the time being, we trade the crosses when they get close to the moving averages. Around this 2150 level will be an ideal time to put on a long gold position, but we are not there yet. And let's have a look at what the gold chart is saying for the next couple of weeks. To me, this is a market which has met all its objectives. Could it trade 1560? Yeah, sure. But basically, it's met all its objectives. It is time for this wave to be exhausted and to do one of these kind of retracements down to the 1450 area up to 1420 area. Basically, 0.382 to 0.618 retracement of this move down from below 1300. That is more likely than not, and it is telling me that equities are in for a period of stability to better prices over the course of the next several weeks. People are going to start getting out of things which are low yielders and things which are better yielders, like equities have become at the moment because of the extreme move down in the bonds, and that chart I showed you earlier with the yellow dots where you start buying equities and favoring equities over bonds. And if that is correct, then the gold price is not going to stay up here. It is much more likely, and the odds are that we come back towards the 1420 area. Well, if we were at the close of the month and we'd close the month here, I know we've got another couple of weeks, so absolutely nothing is decided, what would you say? Well, we had a retest of the monthly moving average. We remained above 2864. We stopped a few people out. Nothing much to write home about. We are more likely to go up towards the 3000 and 2030 area than we are to go anywhere else. And that is basically what I think is going to happen here for the next couple of weeks. I think the market is, if it doesn't stay above, I think it'll definitely close above 2864 on a monthly basis, okay? We start there. But if we really cannot close below this moving average, 2840, and especially this one, 2790, we can forget about this being a very bearish candle. This is exactly what I said when we had this candle. I got very bullish and we went all the way up there. If we now start looking at the weekly chart, we can see much the same kind of thing. Nothing really to write home about, is it? We tried to get down to the lower Bollinger Band, didn't even make that, closed above 2864. To me, the market really is in a 2864 to 2952 effective range. Can we get spikes above and below? Of course. But to me, that is the effective range that you're going to get for certainly the next couple of weeks. Every time the market goes down, people bite because of yield, and every time it starts going up, people start selling it because it's rich on the forward PEs. Makes perfect sense. Why not stay in a 2-3% range for quite some time? On a daily basis, much the same. The resistance, as you can see, is around the real resistance between 29.25 and 29.50, and then we get these levels that we bottomed out at in the 29.70 areas. If we start to enlarge this, basically, every time it gets to up this kind of level, 29.70, I think it's a sell. I think it's a sell from 29.50 to 29.70. This could be an ABC. We might come back down and test the 28.16 level. I don't know, but this kind of area, to me, offers very little value, and I think there is value certainly in these lower areas where the time 17 Blue Angel catches it, and where the yield differential to 10-year is very attractive. This daily tells me the same thing as the weekly and the monthly. Sideways into Fed. Every time it comes down, it's a buy. Every time it goes up above 29, 40, 50, 60, it's basically get out of the way. NQ is actually the one that's been supported most by the bond action, and really the 7,400 all the way down to 7,300 area is going to be extremely good support. So I would expect it to trade to this 77.50 to 77.82 area. Not much below it, above it. I think any spikes above it, and I'm going to be buying put spreads for a move back down to towards the 7,400 area. But I think we are now stuck in a lower volatility regime than we have seen for the past couple of weeks. The RUT, as I showed you earlier in deviations, is very oversold and actually is a pretty good guide to what the markets overall should be doing. It got below the weekly moving average, as you saw earlier in deviations. It was very oversold, way into the green area. Bounce, probably the bounce will extend up towards these moving averages, which are 15.53. I don't think we see 15.70 again. 15.52 is basically as high as I can see it for the next couple of weeks. And then we see what is slightly worrying in these are moving up, aren't they? Moving out rather, these Bollinger Bands. couple of weeks sideways, and then we could go all the way down to the 1400 area. That is actually a mirror of what deviations is saying. If we don't hold this area, if we can't go any higher than 29.50 for a couple of weeks, it'll open up the downside. And if there's any kind of Fed disappointment, it won't be only bonds which will get dragged lower, it'll be equities as well. We could have a rout in absolutely everything, and that is why it's important to stay diversified. Now, another reason why I think we are more likely to go up in S&P prices than down over the early part of next week for sure is volatility, and we have the expiry of the August contract on Wednesday, and we have a slightly descending 200-day moving average. The support from the 50s and around isn't until 1553. We have this swing level at 1627. I think the market is pretty much set up for a slam down into 1553 kind of area over the course of the first 3 days of next week, which should take the market, the S&Ps, up towards the 2940, 2950 area and fill the gap that we opened up on the open of last week. So to me, it's all falling into place. Better dip buyer than rip seller, certainly until the 2950 area, and certainly until Wednesday, when the volatility contract goes off the board. Now, when analyzing any index, really you should always look at its weakest component, which is XLF. Now, while the XLF stays above this line, which is roughly 2603, but let's call it 26 between friends, and it's exactly where he got to and where I bought some. To me, this market is more likely to go up towards 27 and a quarter than do anything else. Then these moving averages will start catching it, but that should give us an index around 2950-ish in the S&Ps. Now, how is that going to happen? Where you could have a little reaction in bonds, which helps XLF go back up. That might actually be bad for XLK, so the spread between XLK and XLF will mean revert. But all that says is that we're going to churn between, let's say, 2864 and 2950-60, so 100 basis point range, unless XLF, which is its weakest component, gives way and starts closing below 26. To me, that is the swing level below 26, and I don't want to know about XLF. I certainly don't want to know about IWM, and I probably don't want to know about SPX either, because some very bad things could happen. But until that happens, I think the upside is more likely than the downside. What I think is becoming very interesting is the DAX. Now, it went through all the levels that I thought it would on the downside. I kept on trying to buy it. I kept on getting slightly stopped, but finally I did catch it, and I'm long. Now, I'm long for two reasons. One is fundamental. I think this Spiegel article that came out is important. It's the first sign that the German government is coming to its senses and that it will do fiscal reflation, which Draghi has been asking for forever. And I think the fact that Draghi was not a politician like Lagarde is actually what stopped the Germans. I think somebody like Lagarde is going to be far better at putting pressure on the Germans to reflate than Draghi was, because she is much more of a political heavyweight. That, to me, whether it reflates just DAX or it reflates France more, I'm not going to get into that argument. Probably France will get reflated more, but that is neither here nor there. We're talking about European equities in general. I think there is a very good chance that European equities now go up at least to 12,000, 12,100. the anticipation of that reflation should be good for it. I see the risk reward here at 11,500 to be far better on the upside than the downside. And that actually matches my view with the S&Ps. It matches my view with the dollar. And to me, being long of calls in the DAX can do far less harm than being outright short of DAX here. I just don't see the argument for being short of DAX in this technical position and with the fundamental news that is coming out. And finally, on to the biases. I've given you the levels here. The ultimate target to me in the 2s is 130, in the 5s is 117, and in the 10s is 139. 210, 215 in the differential between the bunds and the 10-year. I still keep away from trading the bunds on an outright basis. 210, 215 is the level that I like, and after that probably we get a move back towards the 245. This is the SPX levels. I think we get there. I think 29.52 to 29.68 is where I would definitely take profit. 28.64 I expect to hold on a weekly closing basis for quite some time. I don't think anybody's going to sell it through there heavily. I just don't see it. These are the levels. XLF, very important. Keep on watching that. While above 26, it is terribly unlikely to be able to be sold. SPX below the times 17 Blue Angel. Giving you the levels in NQ and RUT where to take profits, and I think VX we go down. We go down to on Wednesday to these kind of levels in the mid 15s. I would have thought is where the expiry is going to be. European equities. This is what I wrote last week. It turned out that it went considerably through me, but I still think that it is considerable support, and I am looking for them to go up to 1200-ish. I think the risk reward is to be long of European equities at these levels. DXY, I have basically said, long-term target 101, 103. The fact that it keeps on closing below 111.08 to me says that at some stage we get a considerable pickup in volatility in that asset class, FX in general, and that it slams up towards the 101, 103 area. Thank you very much indeed, and tweet you on Monday.